Live. Well, good morning, everyone. Welcome to the Baby Boomer Investing Show. We've got a great show today. Good morning, Ron, and good morning to our guests. Good morning, Gil.
Nice to be here with you. It's a pleasure. Thank you.
Okay, and Ron, you want to introduce our guest?
Good morning, Kath and Gil. Gil, thanks for being with us. And this time of day, it's 8 o'clock where you are in Israel, so it's really appreciate you taking the time. So we've known one another for probably 20 years. And for those who don't know you, you're an award-winning financial journalist. Congratulations on your awards. You started with Voice of America and the U.S. News Report, and you've been working. I think we met when you were at Financial Advisor.
No, Research Magazine. I was editor-in-chief there, and that's what.
Okay. Yeah. It was a think tank, right? That was a.
It was connected with thinkadvisor.com.
Think Advisor. Okay. Try to get the story right. But most importantly, you're now sort of self-employed. You're out on your own, but you're doing these podcasts on Seeking Alpha. And for those who are listening to this who don't know Seeking Alpha, it's got a global reach of subscribers and contributors that's in the millions, correct?
Oh yeah, it's
just huge. So Seeking Alpha, Seeking Alpha is a big deal. It really is, and congratulations for being part of that. And the other thing for listeners to this to know is you've written a book called The Mentor, which I think is really a cool book. It brings you inside the lives of two friends who decide to become consultants, and there are different choices about the mentors they choose, and what it means to their lives and what it means to their clients. So it really draws you in. You sort of live their lives through through Gil's eyes. So if you have a chance, it's a great book. It really is.
Well, thank you. I just point out that really the reason I did that is because I spent, I think, over 2 decades writing about financial advisor stuff, always very seriously. And I find that the same issues keep coming up again and again and again. And Sure. It's as if I kind of feel like as if I never wrote anything and my journalistic colleagues never wrote anything. And I thought maybe if I were to sort of fictionalize it, it would sort of stick better. And people would kind of have a deeper, like internalize what the issues are. So anyway, that was the reason I wrote it.
It does stick. There's great messages there too.
It sounds like what you're doing is storytelling.
Yeah.
Right. I mean, the idea is to inculcate character identification, and people could kind of understand the issues by I like this. I feel I agree with this fellow, or I agree with this other character, and just understand what issues face financial advisors. So anyway, that was the purpose.
Yeah.
Well, I like one guy better than the other, and I imagine readers would choose their own hero. So sort of 2 possible heroes in the book and their mentors. So it's pretty cool.
Yeah.
Thank you.
So Gil, what I asked you to do today, and I really appreciate you doing this, is we've been sharing with our viewers some of my thoughts, and we did a little bit of rehearsal beforehand, and you had some different feelings about the things we've been talking about, and I certainly don't want to. I want to open up to other people's opinions. I really would value your opinions. So we're going to talk about unconventional challenges and just want to alert baby boomers to the fact that they're there. And then we've been talking about what they should do investment-wise to protect themselves from what's likely to happen with these challenges. So what I'm going to do is I'm going to go through the challenges, and I'm going to go through them one at a time and describe it, and then ask you to offer your thoughts.
Pleasure.
Are we ready? Okay. Let's go to the second slide, Kath.
Okay.
So in the upper left corner, Gil, you were nice enough when Kathy and I launched the Baby Boomer Show. I'm sure you remember this. You did a podcast about us.
Yes.
And I thought it was excellent. Obviously, I thought it was excellent because it was about us.
Yeah, right.
But I thought you did a great job of describing the fact that everybody goes through life and nobody gets out without going through this. During your working life, there's certainly the risk of loss. But then as you transition from your working life to your retirement, that turns into basically what might be called the risk of ruin. Because at that stage in your life, that green line there is sort of the pattern of your life savings. So you save through life, and then the time comes when you're going to spend that. And if you were unfortunate enough to lose money right at that peak, that's going to change the rest of your life. And it might mean that your money won't last the rest of your life. So if you would just tell us your thoughts on that. And again, I like the words you use in your podcast.
Well, the podcast and whatever I select to do on my podcast is always merit-based. So it's because of the merit of your ideas that your show is featured. But in any event, my first thought about it is maybe a little bit different than I think people might expect. Because I don't know. I think we have sophisticated listeners on the show from what I've seen. And I think people are familiar with the idea of retirement risk and the risk of ruin. But let me put it in a way that maybe people aren't thinking about it. Think about it from the opposite end of the age spectrum. You're a newly married couple. This is not the risk zone, right? This is not you're about to retire. You're 25 or 30, whatever it is. And what your primary financial goal typically is you want to buy a home to raise a family in. So everybody seems to know that you don't risk all of your money before you buy that home because it's home money. In other words, if you put everything in like whatever tech stocks and it crashes right before you want to secure the mortgage, you try waiting another 5-10 years to buy that home. So people all seem to know that. But why is it that they don't know that if I'm about to retire in 1 year, don't let it all ride right now? I mean, like you don't want to have a high risk portfolio right before you're about to retire. You need that money to retire on. So clearing that risk zone safely is critical.
That's a great analogy. That's perfect. So what we've said about the risk zone is that there's a concept called risk management that you touched on in the podcast, Gil. And in the old days of consulting, there was this concept called risk tolerance. And the idea of risk tolerance was get the client to take as much risk as he possibly could bear, because the belief, and this is not self-serving, the belief was that risk will be rewarded. So get them to sign on for as much as they can take, then everybody's going to be happy. That's changed quite a bit, certainly over the last decade. And the notion of risk tolerance has turned into something that might be called risk capacity. And I think you touched on that as well, Gil. That's the same story where, when you're just married and you want to buy a house, you got to just really set a substantial part of your assets aside and protect them. So this whole notion is risk management. And then what we've been talking about in the other shows is it's risk management number one. So if there wasn't all of these concerns going on in the marketplace, you'd still want to be safe. But this bad stuff is going on. And that's just another reason for you to at least consider moving to safety. Now, we might be wrong about the bubbles and inflation and all that stuff, but it's certainly a threat hanging out there. And I want to talk about each of those and then get your thoughts. So the next picture here is about bubbles. Mm-hmm. And there's never, I think, ever total agreement on when a bubble exists, and it only generally happens after it busts. Mm-hmm. And these bubbles might not burst; they might gradually deflate. But I start with one that I think is easy to see. Bond yields have never been lower, and I did do some research, and the last time bond yields were even close to 2, they never got below 2%. 10-year government bond yields. Mm-hmm. Was in the late 30s and 40s. And that was when the U.S. was just coming out of the Great Depression. It took a decade to come out of the Great Depression. So the economy was in the tank.
Right.
But now well, before COVID anyway, the economy was not in a tank, and those interest rates are being manipulated and artificially suppressed. So I call it a bubble. I'll just leave that there for you to comment on. And then the thing about a bubble in stock prices is always a challenge because, relative to what? In one of our shows, we identified 6 measures of overpricing. And one of them that I think has become the most popular now is the Buffett measure, which is the ratio of the value of the stock market to gross domestic product. And that measure has signaled crashes before, but it's never been higher now. So it's at 220%, and it's normally at 80%. So it's way up there. And then we identified 15 reasons why the bubble is going up, and that one sort of ties back to low interest rates. One of the reasons is interest rates are low, so financial analysts discount future earnings at a low rate, and that of course creates a higher fair market value. So all those reasons, I'll turn it over to you, Gil, for your thoughts on. Is there a bubble? Will it burst? When will it burst? These are tough questions to answer, I know, but since you're here, I really appreciate your thoughts.
Sure. I almost don't know where to start, but maybe I'll start here because the last thing you said is, when will it burst? That one is the easiest. I don't know, and don't believe anybody who tells you.
Gary Dent, by the way, I don't know if you follow him, but he has gone on the limb and forecast April. Bubbles are bursting in April. Just so you know.
Anybody who says something like that really ought not to be listened to. No, I mean it, because look, I'm sorry, but this is the way it works. I mean, there's a memory hole. So a lot of people, they'll make predictions. They'll be wrong. They'll make more predictions. They'll just egg on their audience even more because they know that whatever they said before is not going to be important to the reader or to the listener because they're now saying something even more exciting. Eventually, they'll be right. Yeah. I do think that there's, it's a highly speculative. It appears to be a market in which there's a tremendous amount of speculation. I was actually the subject of my podcast today for Seeking Alpha.
I listened to it. It was great. Good podcast.
Oh, thank you. So, you're right. Technically speaking, we won't know if it's a bubble till it's all over. But it would appear to me to be very frothy, highly speculative. Let me tell you, look, you gave a lot of reasons for why we can be skeptical about this market, and I share your skepticism fully. However, and just to be candid with people ought to know this. Think about this. You could have multiplied these reasons a year ago, 2 years ago, 5 years, and people did. Yeah. I mean, look at anybody who was following, let's say, he's hardly alone in this, but John Hussman. He's a brilliant guy, brilliant economist, brilliant. He made gave you 10,000 technical reasons over the course of the last 10 reasons why the market's about to crash, and he was wrong every time. Right? So it didn't happen. So let's just dismiss any notion of timing. Nobody has that ability. These are very complicated things. Markets are complicated. I think people ought to be cautious for all the reasons that you stated. The fact of the matter is we have very little control in what's going to happen in the market. And that's maybe the most troubling thing about the market, the stock market. And that's kind of what the subject of my podcast today was, which is any scenario in which you and a highly uneducated person have an equal chance in, that's not good. Nothing against people who weren't fortunate enough to have a great education. The point is just that's what a world of speculation is. There are people who know nothing about finance, economics, and they're cleaning up. And there are people who are very smart and educated, and they're losing time and again. And that's the market. That's why I'm not saying that people who are educated will always do poorly and people who are not will do well. That's not my point. My point is simply to succeed in investing, you have to take a very long-term approach. There's just no substitute for it. And you have to have an understanding of history. And anyway, so everything you've stated I agree with you. And it's a very, very concerning market. And I think people ought to be very prudent with their money and invest some of their money outside of the market in areas that they personally have expertise in. And outside of that, just take a very long-term approach as if you're investing for your grandchildren. If you do well,
good point.
That's
then
great.
Use the money.
Great.
Okay.
That's great, Gil. So the next two panels, the upper right and the lower left, are sort of intertwined. But one of the things everybody, well, not everybody, I think a lot of people aren't aware of, but this Professor Kotlikoff was on our show two episodes ago, and he's been writing about the off-balance sheet debt. And what he's been saying is, the official debt is 27 trillion, and that's worrisome because our gross domestic product is 21 trillion. So it's only been that high before after the Second World War. So here we are with an official debt that is troubling. But then we have these things that aren't counted, but are real. And basically Social Security and Medicare are the two biggest. And the idea here is if you forecast the benefits that are going to be paid out of Social Security and offset those with the tax receipts that are sort of allocated to pay those benefits, the amount that's unfunded is another $26 trillion. This is even bigger than national debt. And Medicare is even worse. It's another 47 trillion. And then not only that, but the Congressional Budget Office, the official watch guard for the economy, has already reported in their reports that Social Security is going to run out of money in 2026. And COVID now is, I think, pushed up that number. And Medicare in 2034. When I say that on the show, people go, "What does run out of money mean? We got the printing press. We won't run out of money. That's crazy." So I'd like you to comment on that, but also Dr. Kotlikoff is talking mostly about the U.S. economy. I did some research and looked outside the world, and the lower left panel talks about we're not the only country. We're considered the cleanest dirty shirt in the laundry basket. But certainly other countries are spending money like crazy and owe a lot of money. And my best estimate of the per capita world debt is $200,000. Now, Kathy sent hers in, so she's good.
Yep.
You're done.
Yeah.
But this it feels like something's got to break, I guess is all we're saying here.
Sure.
So I don't know what your thoughts are on that, Gil.
I think you're right. When something's got to break and people will be broke. That's what seems to. I see no other art. Look, you mentioned as a reference point World War II, that we never had that high a debt per capita on a per capita basis since World War II. But that's not we shouldn't take any comfort in that and think, oh, we've been through this before, so we'll be fine now. To the contrary, after World War II, 70% of the U.S. budget was devoted to defense spending. Yeah, and maybe 30% to social services and things like that. Today, it's the reverse completely, if not even more skewed. I haven't seen the numbers very recently, but it's at least reversed. Meaning there's just no, the United States could kind of scale down and didn't have to be as engaged militarily after winning such a decisive military victory. Today we have a problem, and not to mention that interest on the debt is artificially low, or interest payments on the debt is artificially low because of the zero rates. So if the rates start climbing, that's going to be quite a bit harder to sustain. So it would seem to be that there's a problem coming. Now, Larry Kotlikoff himself, besides pointing out accurately what the real debt is, and that should definitely give us pause, because I used to worry about the Chinese numbers, that they weren't, there's a lot of manipulation. But even U.S. numbers, while there's transparency, nevertheless, the numbers that you typically hear are don't include off the book debt. So Larry Kotlikoff's numbers are very helpful. But he himself just for the record, doesn't feel like there's going to be a social security crisis. I'm not
Yeah.
sure he's right, but I mean, just to give him, give the other side of an argument a chance.
Well, he laid out the cures, but the cures you look at and you go, I don't know if our regulators are going to do that, just because it could be political suicide. The political will to do it is. Anyway, we'll see.
Well, no, but I think his point is that it's political suicide for politicians not to find the means to pay for.
There you go. That's actually a good observation. Okay.
Yeah. Right. So that's what his point is. And so therefore anything else will be sacrificed, but not that. All right. So we'll see. But the point is, I'm more sympathetic to your point of view than to his on this, because sooner or later, you just can't do anymore. And the current theory, if unstated even, underlying economic policy is that the printing press is going to take care of everything. Modern monetary theory is seeing its day right now, possibly, and so that is concerning. So look, I'll go back to something I just said a moment ago. You could have gone back, about bubbles and markets crashing. You could have used all these arguments 10 years ago, 9 years ago, 8 years ago, and you've been wrong every time. So the same thing could happen here. However, I think that it's the fact that people, there are a lot of investors today, they don't remember. You think about it, people were so scared of investing after the 2008 market crash. There are people today who don't even remember the 2008 market crash.
That's right. Yeah, the millennials don't. They've never they know of it probably, but they never felt it. They don't really know what a big loss might mean to them.
Right. So I think that
of course there's somebody like me who's older, and I just forget about what happened yesterday, let alone what happened in 2008.
There you go. Yeah. You got that going for you.
So I would just say, bottom line is, when people don't even remember, that markets actually go in directions other than up, and that we can't solve all our problems by just turning to the Fed or printing more money, then I think that's problematic. And I think that history does suggest that there are crises, and we certainly have done everything we can to promote one. So I think it's more sensible to expect one than to not.
Okay.
So the next two, the middle one and the one on the right, sort of go together. And so, a decade ago, people were maybe saying something like this, but a decade ago, we didn't have, I'm going to use the number 11 trillion, but let me build on it. So quantitative easing threw about $4 trillion into the economy. And everyone goes, modern monetary theory works. Inflation needle didn't move. Everything's good. Recession was avoided. I like that. That's all good. Mm-hmm. So the answer for any problem now, I think, is to throw money at it. And we have not yet spent it, but we're going to put another $2 trillion in COVID money on top of that 4. And we've already put $3 trillion in COVID relief. So from a humanitarian point of view, I think, wow, that's great. We're really helping people who are in desperate moves. They can't pay their rent. They can't buy their groceries. It's just wonderful. But there's a bill, somewhere there that, and I think taxpayers are on the hook to pay it. But so you've got $4 trillion quantitative easing, $5 trillion in COVID relief, and probably $2 trillion in infrastructure spending, because I think that's part of the platform that Biden got elected on. Mm-hmm. And GDP again is $21 trillion. Mm-hmm. So there's a big pile of money just piling up. And I just had an article published on Seeking Alpha today, Gil.
It's a great article.
Oh, you saw it? Okay.
Yeah, I read it.
Yeah. So the idea is everybody's starting to write about, it's terrible. Interest rates have gone up from 0.5% to 1.5%. And, I think it's good to be concerned, but I think what these observers are really acknowledging is that the whole house of cards falls apart if interest rates go up. So if interest rates go up, we can barely pay the interest on the debt right now. So that's going to mean other things have to give, because the tax pie is only so big. Mm-hmm. And then the other alternative about taking away from Medicare and Social Security is to, again, print more money, which leads us down another rabbit hole.
Mm-hmm.
And the other thing rising interest rates does is it's now the discounts on future earnings from stocks causes the, quote, fair value of stocks to go down. So I think the real concern isn't, a 1% increase. It's where that's heading.
Right. The picture you painted is a picture of a society that's more concerned with the distribution of resources and the distribution of capital than the creation of it, and that's really a problem. That doesn't usually.
It's a great point.
Well, historically, that hasn't worked, and there's ample history to document that over millennia. But this has never been done, and can't. This is what I'm about to say. I don't think can be done unless there's maybe we could. We'll see. I'm about to propose an idea. I'm not talking about surveying economists about what they think today, but imagine through this thought experiment if you could survey economists, let's just say 20 years ago, 10 or 20 years ago, even 10 is fine, and gave the same numbers. Nobody would believe those numbers. Like if you talk to somebody in 2007, before the central bank will print $4 million.
$4 trillion.
$4 trillion. Will through its quantitative easing methods. It's not the same as printing, but it is essentially. So first of all, nobody would even believe $4 trillion. You're crazy. Like they wouldn't think that's possible. And then we're going to spend $5 trillion in COVID relief and all these different things. So just if you asked economists at that time, not do you believe this could happen, but let's take a more concrete question: would the economy survive? This is unknowable, but I would tend to think that most respected economists would think that this is just not going to work. This is before, the advent of modern monetary theory. It's only because it has worked in a sense up until now, meaning there's not that people think, oh yeah, it works. It's a legitimate thing. So that's when I guess the point I want to make is, in my opinion, this works because it has worked. It's worked until now. It works as long as the central bank and the U.S. Treasury have credibility. We have credibility, possibly for the reason that you stated a while ago, a few minutes ago, Ron, which is we're the cleanest dirty shirt in the world.
Mm-hmm.
But as soon as that credibility dissipates, and who knows what the trigger could be, then your next metaphor is quite apt: House of Cards, because this is what's happened throughout history many times. So I think it's something we ought to be prepared for.
I think we're poking the bear, and whenever I say that, people go, well, Japan did it first and they're okay, but that doesn't mean that poking the bear won't finally get the bear mad.
Yeah, right.
Right.
And attack.
So, yeah.
Well, if I may say that, Japan is an extremely apt example. Both Japan and the United States are doing something, and others as well, but Japan started it. That would have been thought unthinkable had we taken that survey. If we were able to do that, retrospective survey that I was proposing. Can you imagine a scenario? Would you ask economists in 2007? Is it possible that the government of Japan or government of the United States is going to buy its own bonds? In the trillions, is going to buy ETFs? That's manipulation. That's this full outright, market manipulation.
Exactly.
Kind of like the United States has often criticized China and other countries for currency manipulation. This is massive manipulation.
It is. Yeah, this just doesn't feel right at all. So on those cheery notes, what I would like to do is just turn to what our listeners can do. And the show is about baby boomers. But I think many of these thoughts can be valuable to younger people, older people. By the way, in terms of where the boomers are in the risk zone, the oldest boomers came into the risk zone in 2001, and they're leaving now. The youngest boomers just came in 2019, and they won't be out until 2031. So we have millions of people who, if they're unfortunate enough to lose money, and I really personally think this decade of the 2020s is going to go down in history as just a shocker. I hope I'm wrong, because there's so many people right now who are at risk, but we'll see. So we've been basically saying to boomers, just from a risk management point of view, whether all these bad things are out there or not, you ought to be thinking, first of all, what is the risk you're taking? I think a lot of people don't even know. They're relying on their financial advisor, and they're doing what they're doing. But I will say that the Employee Benefit Research Institute says that it's 60-40 for every age group. 20-year-olds are 60-40 on average, 40-year-olds, 60-year-olds. And we did a show about the history of financial consulting, which was really sort of fun, the 70-year history. And that 60-40 answer is really, it has a history. And it is the number that people talk about when they talk about model portfolios. We have the best 60-40 model. So why is it 60-40? Well, it's 60-40 because that's just the way it is. It's been that way for a long time. So our number one message has been, find out what your risk is. And second, be leery if it's what we think it is, and move to safety. And then the next issue becomes, what is safety? So on the same slide, Kath, I'm going to do this whole thing right now, just turn it all over to Gil. So this one I don't think I want to do one at a time. We've said 70% in safe assets and 30% in risky assets. And I did that because I have a patented design on target date funds. And my design calls for being really safe at the target date when you're about to retire. By the way, the typical target date fund is about 65% in equities and 35% in bonds. So it's really, really risky. Target date funds are given what I'm talking about here, more risk than you really want to take, although they're $2.5 trillion in the most popular vehicle in 401k plans. Another source you could look to is the Bible. I mean, if you can't trust the Bible, what can you trust? And Gil, you're the one who told me about the Talmud. So it's a third in risk assets, a third in real estate, and a third in safe assets. Then anything that moves you off of 60-40, I think is worth looking at. And then there are other things that we probably should have spoken about more in our shows, but we're going to do that going forward. I've poo-pooed annuities because interest rates are so low. But I think they may still be worth looking at, and I want to do a show on that. And certainly these guaranteed withdrawal kind of programs where you can take the risk off the table and lay it on somebody else. They will promise to pay you so much a year. And then the last thing that we've talked about, so I'm laying a lot out here, I just wanted to get it all out there. Sure. Is if we do see inflation, safe assets won't be cash anymore. So I wrote a thing about Venezuela, and the punchline there was billionaires became penniless, and that's what happens with hyperinflation. So there are ways to take whatever it is that you're going to hold safe and protect it from inflation. So that's everything here. And I just wonder, just overall, Gil, what do you think? In light of risk management, and in light of all these threats that are out there, what you would be advising, and what you see financial consultants advising, what you think they should be advising. So I'm laying a lot on you, but I really value your opinion.
Well, thank you. Well, first of all, just as a sort of a more minor note, but the last thing you mentioned was, the hyperinflation. That was the screen you used there for the last of your 6 screens. Well, in the beginning, you started by talking about 60-40 is the most common asset allocation, which is correct.
Yeah.
Well, inflation, not just hyperinflation, but even just more moderate inflation, is highly destructive of the 40 and the 60-40. I mean, it just kills bonds.
Sure.
And as you were saying, cash, it kills any fixed income. I mean, inflation's a real threat to that. So those two points, your first one and your last one, ought to speak to one another. People ought to think about that. But maybe it's the middle one that, which is the Talmudic portfolio you mentioned, that kind of speaks to every one of the slides. It's not the Talmud is distinct from the Bible, but nevertheless, it's something that I've studied myself personally, and it has a reputation. I mean, people, even if they've never looked at one, seen one their whole lives, they know that there's a certain kind of thinking associated with that. Maybe for lack of a better word, I would try hair splitting. I have learned things that would seem like the most minor point, and you go through pages and pages going like different proofs and arguments for and against, and then overturning the ones that were just proving. And you could go pages and pages on things that would seem to an ordinary person to be a very highly technical issue. What I find amazing about that Talmudic statement, as somebody who's actually learned Talmud, is that there's no debate. It's a sentence. There's nothing. Nobody questioned it.
That's right.
It's just a piece of advice for life, because it was understood to be how a person conducts his life if he wants to live prudently. So what the statement says is one should always divide his assets among land, business, and liquidity. For lack of, I'm trying to translate as best I can from Aramaic. And the first thing I'll point out about it is the word always. Always. That's part of it too. Let's not forget, it's not just a throwaway word.
Yeah.
The reason why there's no debate on this is because people the Talmudic sages who had a very long-term perspective, so long that what they wrote about and discussed and debated has relevance today from A to Z. They had a knowledge of what life is like and what history is like. And people tend to be very short-term, and they don't realize that there's no life without risk. Now, there's no life without something blowing up. That's just a part of life. But I also want to take a good, careful look at this. I don't want to leave people depressed. I hope when people leave this show, they'll feel empowered. They'll feel uplifted and inspired. And so one way to do that is, just like I pointed out the word always, let me also point out that the division, the recommended allocation, is highly optimistic, right? Because two of them are forward-looking and optimistic, risk-based, or opportunity-based, let's say, and then one of them is risk-based. So the opportunity-based is land, like real estate, and also business, stocks, or in today's terms, perhaps, or personal businesses somebody owns or operates. Whereas cash that's the risk-facing one. The cash is basically gives you the opportunity to pivot, because first of all, it gives you survivability. Survivability. And what happened to my English here? Secondly, and it will get to actually addresses directly your point about like target date funds and your particular fund. So we'll get to that in a second. But it also understands that, generally speaking, people do well through investing. That's why people should take risks and should seek opportunities, because by doing so, they will profit. So you need to do that. It ought to be done prudently. So your target date fund, which has much better results and far safer than the existing commercial alternatives, it recognizes there's a period of time when you want to make sure that you're covered. And so one thing a person could do, like you were criticizing 60-40. Let me just say, I'd be okay with 100. I actually would prefer 100% stock. No.
Okay.
But let me clarify the point.
Okay.
Because I'm really not a fan of bonds, but and especially with inflation risk. But let me clarify the point. That's assuming you have other things too. So it really isn't. So this money is fungible. It really isn't 100%. If you own a home, it's for sure not 100%.
Yeah.
If you have some cash on the side, it for sure isn't 100%. Really, people ought to try to divide their risk according to that recommendation, I think. And then they will be secure. They'll have the home there to live in. They'll be profiting, but not profiting greedily, because when you profit sort of greedily and you're like, everything's, you don't have the home, you don't have the cash, this is all stocks, you could lose it all. And it happens all the time.
Sure.
And the same thing in real estate. There are people who love land. They don't care about stocks. It looks like a casino to them. So they're all in land. They lose everything, and literally everything. This happens all the time. People, what we ought to do, listening to this, everybody should interview their grandparents if they're still with us, or their parents if they're still with us. And if not, people who have attained a certain age, wisdom, and experience, and find out what actually happens in life. But losses occur, and you don't want to be stuck in one category, even if it happens to be today's hottest category. Don't put 100% of your assets into Bitcoin, okay? You should really have it in various different things.
So help me with the safe part of the third. Sure. I sort of get the real estate. I sort of get the business. But what you're obviously, you know the Talmud well. What is the real meaning in the Talmud for what is safe? What is it? Under the mattress safe, or what does it really mean?
I think the example given on that page was buried into the ground. Actually, I think the mattress was dismissed as an option, but no, literally it was discussed. Yeah. But that was the preceding discussion. But the thing is, I would characterize it, I think, like this. Through a story. Let me tell you a story. I was saying everybody should ask their grandparents, or people they know with age, life experience. This is a story. There are many like this, but it just left a really impression on me. I met a guy once, many years ago. I can't remember his name even, because I didn't know him personally. But I kind of moved into a community right when he was moving out, and he was telling a bunch of people why he was leaving LA, which is where I'm from, and moving to Dallas.
Okay.
Basically, for the reasons that anybody could probably guess, he couldn't afford real estate in LA. LA is quite pricey, as is all of Southern California. Mm-hmm. And I'm sure he liked it here, but he was going to go to a place where he could afford it and have more opportunity. Very nice person, very sort of ordinary in his speech and his appearance. I mean, he didn't meaning to say you didn't get the sense that this was from the House of Rothschild or anything like that. But the interesting thing is he happened to mention in passing something that just really struck me, that a few generations before, he came from an extremely wealthy family. Mm. They were huge landowners in a city somewhere far away, a big city. I don't remember which one at this point. But at the time, I mean, in today's terms, we're talking about multi-billionaires.
Wow.
That's what I'm saying. If he owned that kind of land in that city, he would be a multi-billionaire, if not, maybe a trillion. I don't know. Huge amount of land in a major city, but he didn't own any of that land. He couldn't afford to live in LA, and he moved to Dallas for that reason. That I think is a very significant point, which is that what happened apparently in his family was a crash. The economy crashed. Land was no longer worth that. His family fortunes were tied completely to the land, and they were stuck with debt. They had to sell everything they had. These things happen all the time. It happens in every generation. It happens. It's not just him and his time and his place. It happens to everybody in everybody's time and everybody's place.
Sure.
So his problem was, the booming stock market of his time was land, and that's what they all owned. And when the time came, the game of musical chairs was called and it was up, and everybody had to go find their seats. They had no seat. They had nothing but debts, and then his family declined into poverty. And so this is the thing that really, I think, explains your question about that's the value of cash. If he had cash, he would have had survivability. I understand, inflation is an issue. That's why you should never have only cash. and nevertheless, you have to have some liquidity. And that, I think, is proven especially well by your target date fund. That's what it gives you. It gives you survivability. It gives you the ability to make it. Another possibility is you keep your portfolio. That'd be 60-40. Let it be 100% stocks. Fine. But make sure that you also own your home, and make sure that you also have enough to live off for several years, and you're fine. Then you don't even need Ron Surz's target date fund. If you have like enough cash to live for, let's say, 5 years, whatever, because the next market crash could be a very big one. I mean, some people say 3. I'd be more conservative. If you want to be really conservative, you would say even 7 years, because that'd be the longest downturn lasted that amount of time. But that's the idea. So you could even have 100%, except that really everybody should have some of those different categories. And then when land's doing well, great. You don't worry about your stocks not doing well. When land's doing poorly, you don't have to worry about your stocks. And so, today I'd say, sorry, this is a different point, but I'll just make it anyway. I think that it's slightly worrisome to me that it seems like everything's doing well right now. Real estate.
It's insane. I mean, the bad news comes into the economy, and the stock market goes up. It's there's a total disconnect.
And that's even more worrisome. That not only is I mean, it's not like we have. It's not like we're expanding, creating new markets, new types of technology. I mean, there are technical innovations, but they're not like fundamental, like, the rail lines or something just completely new. We're riding off technology that we've had. We're just making micro adaptations to technology that was, invented, decades ago already. Yeah, it's concerning. But in addition to which, we have a veritable plague of problems. I mean, crisis after crisis, Corona being one of them. So it's not the sort of thing that you would expect to see markets booming afterwards. And
right.
If it's happening, it's even more of a sign that we ought to be concerned. And so again, if everybody who's listening got my point, and I think yours as well, I hope they'll realize I'm not talking gloom and doom, even if it sounds a little bit like that. I actually prefer to keep an optimistic focus, and I think listeners to my podcast know that I try to be that way. And I am. I'm generally an optimistic person. But I think
and realistic.
Realistic. Oh, thank you. So I think that's really what it is. Let's be realistic, and let's spread our bets, and not like put everything in one pot.
Great. So we're at our 45-minute timeline. Although,
Gil, we want to talk about.
Yeah, well, we do. I just you're right, Kath. I don't know if you had any questions for Gil before we move on to telling people how to reach him or whatever. You can reach Gil here. You can see the email address, and he has a website. And I think there are other ways to reach you, but I think if you start on the website, you'll find all the others: Twitter and Facebook and LinkedIn and all the others. So you did a great job, Gil. I really appreciate your insights. It's great to have you on the show.
And thank you so much for being on the show, Gil. I'm actually overwhelmed over your storytelling skills, because I found myself seriously. I love stories. All women love stories, especially ones that are compelling. And I like how you take the financial side for baby boomers and you put it into a scenario. And that was very compelling. So it was easy for me to follow. As the baby boomer on this side that is not knowledgeable, I learned today. So I want to thank you for allowing me to absorb your information and learn from you.
And some people won't know this, but Kathy and I are brother and sister.
Yeah.
So anyway, but that was a great job.
Okay. Thanks so much.
Thank you for your gracious remarks. And it was actually my pleasure discussing this with you. It was a fun talk. And
thanks.
Thank you, Kathy.
Okay, thanks for being on the show, Gil.
Before we go, we need to brag about something Kathy created last week. And this is incredible. So in 1 week's time, she put together a terrific website, and it's easy to find. It's babyboomerinvesting.show. I don't think you need the www, do you?
No, and you know what I did, Ron, is I put it in the description now.
Okay.
Not in the description. I put the links in the comments of the show right now. But I'm going to go through this and I'm going to show you guys. This is the website.
Okay.
Okay. And what's nice is first you're going to see the past shows. some of the past shows, and then Ron keeps saying that I photoshopped this. I really didn't. This is what he really looks like, and of course that's what I look like.
Yeah.
So what we want to ask you to do is go to the website and go down below here and fill in the form so that you can stay informed. We're having newsletters that will be going out to keep you advised about the upcoming shows as well as the past shows. And of course, now if you want to go to the live show, you're welcome to do that. And today's show actually was broadcast directly on our website as well, but you'll also be able to go in one place and look at all of the previous shows. In addition to that, we'd like to invite you to be on our show as a guest. And in order to do that, you have to fill out a form. Now, we're not going to ask you a whole lot of questions, but we do want to know the area of interest that you have. So let's say you want to be on futures, you're going to click that, and any other area that is of interest, and then what the show title would be and what kind of contribution. We're looking for people that are making contributions to the well-being of baby boomers on the financial end. And then, of course, the news area is really our blog area so that you can find out about the news that's going on. And we have a list of the resources, which are fantastic. Ron had put together a really nice PDF or PowerPoint presentation as well. And I thought, well, rather than having to duplicate it, we're going to send this to you directly. So if you click on this, it's going to bring you to a PDF that you can download. And what's nice about this is every single one of these areas, Ron has created that into a link directly to the show, as well as his library, his article library. So Ron has written a lot of articles, and he's also written a number of books, but you can get directly to these from one from one resource. So we really like that. And then, of course, there are a number of related organizations that are associates to the Baby Boomer Show, and Ron has indicated who all these are and what they are capable of doing. So you might want to explain a little bit about like glide path and target date and that, Ron.
No, I think it's a good overview, Kathy. You've done a terrific job here, and I'm just so proud of you. It's
okay, and as a joke here, but
that's
really,
not a joke.
Not really as a joke. If you want to get a Baby Boomer Investor T-shirt, or you want to get some wall art, or you want to get a pillow, or here's even a throw pillow you can get, and you can get that on the website as well. So
great.
Also the links, we invite you to like us on Facebook, to subscribe to our YouTube channel, and also if you're on LinkedIn, please feel free to follow us on LinkedIn. So that's it.
Great.
Okay.
Great show, Gil. Are you still there?
Yeah, Gil is still here. Yeah.
I know you've got a dinner with your son-in-law now, so.
But, I'm meeting with my son-in-law in about minutes. Yeah.
Well, I hope it's good, and thanks again. It was a really good show.
Okay,
well,
we have
both, and congratulations on the new website. It really looks great. And
thanks. Okay. Thanks. All right. Well, bye everyone. Thank you. We'll see you next in a couple of weeks. Okay.
2 weeks.
Yep. 2 weeks. Yeah. Bye.